On January 5, 2026, silver was trading around $75.50 per ounce after rising nearly 4% in a single session, with Reuters reporting that the spot market had set an all-time high of $83.62 just a week earlier on December 29, 2025. That same December 29th session also delivered a near-immediate reversal, with Reuters reporting a 9.5% drop to roughly $71.66 after the intraday record. In the first days of 2026, the silver market was already defined by large daily swings, record price territory, and a calendar full of scheduled mechanical flows tied to indexes and derivatives. In parallel, a separate timeline from 2020 remained embedded in how many market participants talk about silver. The record enforcement actions that culminated in a $920 million resolution involving JPMorgan and documented schemes in precious metals futures and U.S. Treasury markets. The two timelines intersect in a simple way that does not require speculation. When a market experiences extreme volatility, the demand for explanations rises, and past, well-documented enforcement cases become reference points, especially when they involve the same instruments and venues that still set benchmark prices today. The factual record of what happened between 2008 and 2016, what regulators announced in 2020, and what courts imposed on individual traders in 2023 exists independently of any claim about the causes of price moves in late 2025 and early 2026. But those facts shape how narratives persist because they are public, specific, and tied to the core mechanism of price formation in modern metals markets: futures, order books, liquidity, and settlement. To understand why a 2020 spoofing case continues to be cited during 2026 volatility, the starting point is the structure of the silver market itself. Silver is priced globally through a hybrid system that combines exchange-traded futures and options, over-the-counter spot transactions, and large pools of vaulted metal held for ETFs, industrial users, banks, and investors. In the United States, the COMEX silver futures contract is a central reference point for leveraged exposure and short-term price discovery. In London, the largest over-the-counter precious metals hub, the market operates through bilateral trading and a settlement infrastructure built around clearing and unallocated metal accounts. The London Bullion Market Association describes clearing through London Precious Metals Clearing Limited as a system owned and managed by 4 LBMA market maker banks with unallocated precious metal in accounts used to settle trades between themselves and on behalf of clients, even when counterparties are located around the world. London's market structure matters because it is the global hub where large stocks of precious metals are held and transferred, and because London spot conditions can diverge from U.S. futures under stress, creating price premiums, unusual shipping economics, and changes in where metal is physically located. In October 2025, Reuters described one of the clearest examples of how physical tightness and settlement mechanics can spill into pricing and logistics. Reuters reported that London's spot market experienced tight liquidity, that silver traded at a premium to U.S. COMEX futures, and that the premium became large enough to make airplane deliveries of silver profitable, a transport method normally associated with gold due to cost. Reuters quoted estimates that roughly 15 million to 20 million troy ounces, or about 311 to 467 metric tons of U.S.-based metal arrived in London over a week. And another source cited at least 1,000 tons flowing into London vaults from the U.S. and China. Reuters also reported that London vaults held 24,581 tons of allocated and unallocated silver valued at $36.5 billion as of end September, and that Consultancy Metals Focus estimated 83% of the silver in London vaults had been allocated to ETFs, meaning large inventories existed, but much of it was not readily available for the spot lending market. In the same Reuters reporting, COMEX inventories were described as having surged earlier in 2025 due to uncertainty over U.S. import tariffs, and Reuters provided a specific benchmark for the scale of U.S. stocks. COMEX silver inventories had hit a record high of 16,543 tons, or 531.9 million troy ounces, on October 3rd, before about 697 tons left COMEX warehouses since that peak. Reuters also reported Shanghai Futures Exchange silver stocks falling by 249 tons in a week to 920 tons, the lowest since May, described as the largest weekly outflow in 11 years. These are not rumors or interpretations. They are quantified movements and stock figures reported in the context of a liquidity squeeze, and they show why the silver market can shift from paper pricing conversations to physical transport and vault availability in a matter of days. When price volatility accelerates, the market's dependence on derivatives becomes more visible because margining, open interest, and systematic rebalancing translate price moves into forced or scheduled flows. Late 2025 provided a set of data points that make that linkage concrete. Reuters described silver's exceptional annual performance in 2025, reporting gains large enough to push the market into record territory, and describing drivers such as critical mineral policy, supply constraints, and rising industrial and investor demand. On December 31, 2025, Reuters reported silver had gained 161% in 2025 and had broken $80 per ounce for the first time. On January 5, 2026, Reuters reported silver was up 3.9% to $75.50 after having reached an all-time high of $83.62 on December 29, and reported that silver ended its best ever year on record, 147% higher. Those two Reuters figures, reported days apart, underscore a basic point about fast markets. The choice of measurement window, instrument, and timestamp can produce different headline returns even when the underlying story is the same, because the late December price range was unusually wide. Into that environment comes a scheduled event that is mechanical by design: index reweighting. Barron's reported that silver and gold could face near-term selling pressure driven by the annual rebalancing of the Bloomberg Commodity Index scheduled between January 8 and January 14, 2026. Barron's reported that tracked funds tied to the index were about $109 billion and that target weights implied large flows, citing a JPMorgan analyst estimate of roughly $3.8 billion in silver futures selling and $4.7 billion in gold. Barron's also reported an estimate of around 13,000 COMEX silver lots, described as about 9% of open interest, potentially being sold as part of rebalancing alongside an estimate of 11,000 gold lots. This kind of scheduled futures selling does not require a narrative about motives. It is a function of index methodology, target weights, and the pipeline of assets tracking the benchmark. In a market where Reuters simultaneously described record prices and single-day moves approaching double-digit percentages, the existence of a known, time-bounded rebalancing window becomes one of the few elements that is both measurable and scheduled in advance. This is the point where the historical enforcement record becomes relevant as a reference, not as an explanation for any specific 2025 to 2026 price move. JPMorgan's $920 million resolution is a public documented case about the mechanics of influencing prices in precisely the venues where silver is most heavily traded: futures order books. On September 29, 2020, the U.S. Department of Justice announced that JPMorgan Chase & Company entered into a deferred prosecution agreement in connection with criminal charges related to two schemes to defraud, one involving precious metals futures and another involving U.S. Treasury futures and cash markets. The DOJ described the period for the precious metals conduct as approximately March 2008 through August 2016, involving gold, silver, platinum, and palladium futures traded on the New York Mercantile Exchange and Commodity Exchange, which are operated by CME Group. The DOJ described the resolution as involving over $920 million in a criminal monetary penalty, criminal disgorgement, and victim compensation, with credits tied to parallel CFTC and SEC actions. The Commodity Futures Trading Commission, on the same date, described its order as a record $920 million for spoofing and manipulation, and specified the components: $311,737,008.23 in restitution, $172,034,790 in disgorgement, and a $436,431,004 civil monetary penalty. The SEC also on September 29, 2020, announced that JPMorgan Securities admitted to manipulative trading in the U.S. Treasury market and that, across DOJ, CFTC, and SEC actions, a total of more than $920 million was to be paid in restitution, forfeiture, disgorgement, penalties, and fines. JPMorgan's own investor relations statement described entering into the DOJ deferred prosecution agreement and paying approximately $920 million, with the DPA set to expire after 3 years if obligations were met. The mechanism at the center of the case, spoofing, is not a theory. It is a defined practice that regulators described in detail. In simplified operational terms, spoofing involves placing orders that are intended to be canceled before execution in order to create a false impression of supply or demand, influencing how other participants respond, and then executing genuine trades on the opposite side at improved prices. In futures markets, where the visible order book influences algorithmic and human behavior, the ability to change perceived depth can change short-term price dynamics, especially in less liquid conditions. The public enforcement record matters in silver because it ties this practice to precious metals futures over an extended period and attaches an unusually large penalty to it, making it one of the most cited spoofing cases in modern commodity market history. The 2020 corporate resolution was not the endpoint of the public record. Individual accountability produced additional court-documented outcomes. In August 2023, the DOJ announced prison sentences for two former JPMorgan precious metals traders, describing that Michael Nowak, a former head of precious metals trading, was sentenced to 1 year and 1 day in prison, and Greg Smith, a former lead precious metals trader, was sentenced to 2 years in prison in connection with a scheme to manipulate the precious metals markets. Those sentences are part of the factual timeline that keeps the case present in market conversations because they show the enforcement pathway from desk-level conduct to corporate resolutions and then to individual incarceration. The persistence of manipulation narratives during 2026 volatility can be explained with publicly observable facts about how silver is traded and held, even without attributing any specific intent to any current participant. First, pricing is concentrated in a small set of benchmarks and venues, even if physical metal is dispersed globally. Second, large segments of global inventory are held in forms that are not easily mobilized during stress, such as ETF-allocated holdings in London vaults. Third, when London spot conditions tighten, physical flows can reverse at scale, including intercontinental transfers measured in hundreds of tons. Fourth, systematic strategies and index-linked flows can produce large futures transactions on known dates. Fifth, in a market with a history of documented spoofing, participants have an existing public example of how order book behavior can be used improperly, and that example involved one of the world's largest banks and the exact asset class under discussion. Another reason the JPMorgan case remains a recurring reference is that the bank appears in multiple parts of silver's modern infrastructure in ways that are explicitly documented in public filings. One example is the iShares Silver Trust, one of the largest silver-backed exchange-traded products in the United States. In SEC archival prospectus materials for the trust, JPMorgan Chase Bank N.A., London branch, is identified as the custodian responsible for safekeeping the trust's silver, while the Bank of New York is the trustee. These roles do not imply wrongdoing. They describe custody and administration, but they do place a major bank within the operational chain that links retail and institutional ETF demand to vaulted physical metal in London, which matters when Reuters reports that London's available silver can tighten even as total vault holdings remain large, and when Reuters reports that the majority of London inventories are spoken for by ETFs. The same pattern exists in London market infrastructure. LPMCL's own published member description states that clearing is provided by a not-for-profit company owned and operated by 4 clearing LBMA members: HSBC, ICBC Standard Bank, JPMorgan, and UBS. In other words, the same set of large banks appears in the settlement plumbing of London's precious metals market, while U.S. futures remain the leveraged price discovery engine. This is a structural fact about how global precious metals settlement has been organized. The policy layer added another set of measurable drivers in late 2025. In November 2025, the U.S. Geological Survey published information noting that the final 2025 list of critical minerals added 10 new minerals, explicitly including silver. The Department of the Interior also stated in its press release that the final list added silver among those 10 new minerals. The Federal Register notice for the final 2025 list describes the expansion and the methodological basis for additions. Reuters reported in 2025 that this policy shift intersected with market expectations about potential tariffs and supply chain vulnerability, and Reuters also reported that silver's designation as a critical mineral was part of the backdrop for its strong performance. Again, none of this requires inference about future prices. It provides a documented context in which U.S. industrial policy, supply risk frameworks, and trade measures can alter how markets think about strategic commodities. By late 2025, Reuters also provided an explicit data point on the magnitude of silver's rally and the set of cited drivers. In mid-December 2025, Reuters reported silver surging to record highs above $65 per ounce, citing a perfect storm of factors including investment demand, speculative momentum, its addition to the U.S. critical minerals list, and continued supply deficits alongside industrial demand linked to sectors such as AI, data centers, solar cells, and electric vehicles. Reuters reported a price of $66.87 per ounce and described a gain of more than 120% during 2025. Then, by December 29th, Reuters reported silver reaching $83.62 intraday before falling sharply. By January 5th, Reuters reported silver at $75.50 after a geopolitical-driven broad move in precious metals. These price points, tied to dated reports, illustrate that the silver market moved from the mid-60s to the low 80s within weeks, and then experienced rapid drawdowns and rebounds. In this environment, inventory data becomes part of the factual record that editors, analysts, and market participants cite because it provides a measurable snapshot of deliverable supply. CME Group publishes daily warehouse stock reports for COMEX metals, including silver. In the CME Silver Depository Report with activity date December 31, 2025, total COMEX registered silver was listed at 127,264,198.251 troy ounces, while total eligible silver was listed at 322,509,169.947 troy ounces, for a combined total of 449,773,368.198 troy ounces. In the same report, the JPMorgan Chase Bank NA depository line listed registered silver at 16,298,153.99 troy ounces and eligible silver at 171,955,843.583 troy ounces, for a total of 188,253,997.573 troy ounces. These figures do not describe ownership of metal by the bank. They describe the quantities stored in a depository facility under COMEX classifications, but in a market where Reuters reported London liquidity constraints and where ETF allocations were described as tying up a majority of vaulted silver, warehouse classifications such as registered and eligible become part of how participants discuss immediate deliverability versus total stored metal. The registered category matters because it is commonly used to describe metal that is available for delivery against futures, while eligible generally refers to metal that meets exchange specifications but is not currently registered for delivery. The distinction becomes salient during periods when futures delivery interest rises because the transition from eligible to registered involves operational steps and decisions by holders. During a high volatility period with heavy futures activity, these categories can become headline figures, even though the underlying reality is that most futures positions are closed financially rather than delivered physically, and that physical delivery is a specialized part of the market rather than the norm for most participants. When prices move violently, questions about who is buying, who is selling, and why tend to accumulate around the largest visible institutions and the most visible mechanisms. That is where persistent rumors become describable as a social fact without endorsing their content. The silver market has a documented history of public debate about suppression and manipulation claims that predates 2020 and intensified during episodes like the 2021 retail trading wave. In February 2021, Bloomberg reported that silver bugs have long claimed that prices are suppressed as the Reddit-driven frenzy in financial markets spilled into commodities. Reuters, on February 1, 2021, reported that Reddit investors debated whether attention to silver was distracting from GameStop, and cited the view that the silver market's size and institutional participation made it less susceptible to coordinated retail influence. Those reports document that claims and counterclaims about silver's price behavior have circulated publicly for years, often accelerating during periods of unusual price action. What makes the JPMorgan case distinct in this context is that it is not an abstract allegation. It is a resolved enforcement record describing unlawful conduct tied to a defined period with dollar penalties and prison sentences. The DOJ described schemes covering March 2008 through August 2016. The CFTC described a record $920 million order with restitution, disgorgement, and civil penalties, quantified down to the dollar. The SEC described admissions regarding manipulative trading in the U.S. Treasury market, and a total payment across agencies exceeding $920 million. JPMorgan described the DPA and the approximate amount publicly, and the DOJ later described prison sentences imposed on former precious metals traders. These are the components of a documented legacy, not a claim about what is happening in 2026, but a set of public facts that permanently changed how one major market participant is referenced in discussions about metals market integrity. At the same time, the late 2025 and early 2026 volatility can be described using dated, attributable facts without assigning hidden causes. Reuters reported profit-taking pullbacks and quoted market participants describing the move as a response to spectacularly high levels after rallies. Reuters reported that geopolitical events drove safe haven demand across precious metals on January 5, 2026, with gold moving sharply and silver rising more than 3% earlier in the session. Barron's reported that a scheduled index rebalancing window in mid-January 2026 implied significant potential futures selling flows. Reuters reported that physical market tightness in London in October 2025 created conditions where silver moved by air freight and where hundreds of tons moved between regions, while London vault inventories remained largely allocated to ETFs. The USGS and Interior Department reported that silver was added to the 2025 critical minerals list, providing an official policy change that Reuters and other outlets linked to market attention. CME Warehouse reports provided daily tallies of registered and eligible COMEX inventories, including the breakdown by depository facility. Each of these items is a discrete fact with a date, a number, and a source. Together, they describe a market where price discovery is a mixture of leveraged futures, tight physical availability in specific locations, and policy-driven attention to supply chains. Within that framework, it is also possible to describe who objectively benefits from certain categories of activity without asserting motives. When large price ranges increase trading volume, exchanges and clearing systems process more transactions and collect fees per contract and per cleared trade. When volatility increases, the demand for options, spreads, and hedging tools increases, and intermediaries facilitating execution and clearing handle more flow. When physical tightness makes air freight economical for silver, logistics providers and vault operators become part of the marginal supply route, and Reuters documented that such routes became profitable under London premiums. When inventories move across regions, refiners, transporters, and vault networks must coordinate bar formats, location, and settlement requirements. When an index rebalancing window is scheduled, futures volumes can concentrate into a few sessions, and market liquidity during those sessions becomes an observable constraint, as Barron's cited with the view that silver's liquidity is lower than gold's and therefore more vulnerable to price impact from mechanical selling. None of these statements assigns intent. They describe how market infrastructure functions and who is structurally positioned to provide services when activity rises. The remaining piece is why the word manipulation reappears so quickly in public discourse during volatility. Here the factual chain is simple. First, the silver market has a documented record of enforcement for spoofing and manipulation in precious metals futures, including silver. Second, that record includes a $920 million resolution and prison sentences, making it unusually salient. Third, modern price discovery in silver still relies heavily on the same futures venues and the same kinds of electronic order book dynamics that spoofing exploits. Fourth, recent volatility has been extreme, with record highs and rapid reversals documented in Reuters reporting, and with scheduled index-linked flows documented in Barron's reporting. Fifth, during periods of stress, the physical side of the market can show localized tightness even when aggregate vault inventories are large, as Reuters documented in London, and such divergence invites debate about how paper prices relate to metal availability. These steps do not prove any new wrongdoing, and they do not need to. They explain why a historical enforcement case can remain a live reference point years after the conduct ended and years after the corporate resolution was signed. The documented endpoint of the JPMorgan case is also relevant. A deferred prosecution agreement is time-bounded by design, and the DOJ's published case page describes the DPA, arising from charges related to the two schemes, and specifies the criminal monetary amount of $920,203,609. JPMorgan's statement described the DPA expiring after 3 years if obligations were fulfilled. These facts matter because they set boundaries. The public record identifies a defined conduct window ending in 2016, a corporate resolution announced in 2020, a DPA framework with conditions and a time horizon, and prison sentences announced in 2023. In parallel, the public record for late 2025 and early 2026 identifies record prices, large daily moves, policy changes that elevated silver's strategic profile, localized physical tightness that moved metal across borders and into London vaults, and scheduled index-linked flows expected in January 2026. The overlap is not a claim of continuity. It is the coexistence of two factual timelines in the same market. One is about how manipulation was proven and punished in the past. The other is about how today's market mechanics, inventory constraints, policy signals, and systematic flows can produce dramatic volatility that invites renewed scrutiny. By early January 2026, the silver market's headline numbers were already sufficient to sustain attention without adding any unverified explanations. Reuters reported spot silver at $75.50, an all-time high of $83.62 days earlier, and a 9.5% drop on the same day the record was made. Reuters reported that London's market had previously tightened enough to make air freight viable and quantified flows of 15 to 20 million ounces and at least 1,000 tons into London vaults, while also quantifying London vault holdings at 24,581 tons and describing 83% allocation to ETFs. CME Warehouse reports quantified COMEX registered silver at 127.264 million ounces and eligible silver at 322.509 million ounces as of December 31, 2025, while listing 188.254 million ounces in total at the JPMorgan depository facility. The USGS and Interior Department documented silver's formal addition to the 2025 critical minerals list. Barron's documented a scheduled index rebalancing window from January 8 to January 14, 2026, and estimated futures selling volumes and lot counts tied to that schedule. And the DOJ, CFTC, and SEC had already documented with dates and dollar amounts how spoofing and manipulation occurred in precious metals futures between 2008 and 2016, and how it was resolved in 2020 with prison sentences imposed in 2023. Those are the pieces of the factual record. The conclusion about what they mean belongs to the listener.